everyone, welcome back to Mindful Investing. Today I want to show you a simple formula that can help you average down on your stocks wisely. I use this all the time before buying more shares of a stock that is falling in price. This gives me a clear picture of how my average price will change and how much potential return I could get if the stock recovers. Here's the formula. You multiply old quantity with the old average price and add it with the new quantity with new average price, and now you divide everything with the total quantity. This will give you the new average price. Let me break it down in simple terms. Old average price is the average price you originally paid for the stock, and old quantity is the number of shares you already own. New price is the current price at which you plan to buy more. And finally, the new quantity is the number of additional shares you want to buy. By plugging these values into the formula, you'll get your updated average price after averaging down. This tells you exactly how much you need the stock to go up from now to break even or make profit. Once you understand this, you'll make better buying decisions instead of just blindly buying the dip. Let me give you two real examples from my own portfolio. So let's take AMD as the first example. I currently have 20 shares of AMD with an average price of $106, but right now AMD is trading at $93. So I'm down about 12% on this position. Now, based on my own research and stock prediction tracker, I believe AMD has a 25% upside in the next 1 year. So I want to bring my average price down. And let's say I buy 20 more shares at an average price of $94. Now I'll have a total of 40 shares and my new average price becomes $100 per share. That's much better than $106 and gives me much more higher chance to make profit when AMD starts moving up again. And the second example, let's take SCHD. I have 210 shares of SCHD with an average price of $27.63. Right now it is trading around $25.30. So I'm down about 8% on this position. So let's say I want to buy 100 more shares at an average price of $25. I will have a total shares of 310 and my new average cost will be $26.78 per share. Just like that, I've improved my position, and when the stock starts recovering, I'll break even much faster. So before you buy more shares, it's very important to understand what happens when a stock falls big. Here's a simple chart you must remember. If a stock is down 50%, it has to go up 100% to break even. And if it is down 60%, it needs to go up 150% just to break even. And if it's down 70%, it has to go up 233% just to break even. I'll link this chart in the description so you can check the full chart later. So think about it. If your stock is down more than 50%, it might take years to recover. Meanwhile, your money is just sitting there doing nothing, and you're already going through the mental stress of seeing that loss every single day. So what should you do in these cases? You have two options. If you truly believe in the company's future, try to bring down your average price at key support levels. This way you recover faster and stay invested. If you don't see strong upside, then maybe it's better to sell that stock and move that money to a better opportunity, a stock that is growing now and can give you better returns than back holding a dead stock for years. The idea is simple. Make your money work for you. So the next time you average down, use this formula, calculate your new average and ask yourself, will this stock grow in the next 1 to 2 years? Can this recover faster if I invest somewhere else? This small step can make a huge difference in your portfolio. Also remember, mindful investing is not about reacting emotionally. It's about planning your moves and staying confident in your strategy. If you found this video helpful, please like, comment and share it with someone who's bag holding right now. And don't forget to subscribe. Thanks for watching and I'll see you in the next video.